Hey, what's happening, Market Rebels? Happy Monday, everyone. Another tiny sell-off in the markets today, but just more volatility, and that's what we're here to talk about on Trading TuneUp. So if you're brand new to TuneUp, it's absolutely great having you here. We do this every Monday, Thursday, Friday at 4 p.m. There are also archives, so you can go back and review them. The idea is just to give you ideas, tips, and tricks that the professional traders often use that most of the kind of typical options traders don't know. So for today, what I thought would be helpful is to talk about a specific strategy, but with a little different idea in mind. We're going to talk about what is a straddle-straddle swap, and I've also written about this in Ryan and Wayne's service for this week, for those of you who are in that service. But there's a bigger message behind here, and that is, it sounds like a really complicated strategy. And unfortunately, a lot of times when traders are learning strategies, they try to memorize every single one. And yes, that's going to be a daunting task. But what I want to show you is a really easy way to break down strategies. And once you can do that, you don't really have to worry about what they're called. You can just kind of do a quick calculation, maybe sketch it out on paper, and you can eventually figure out what these strategies do. So let's take a look at a straddle-straddle swap. And we're going to first start with a straddle. And that is, I think, a strategy that most of you know, where you're going to buy a call and a put with the same strike and expiration. So for instance, you might buy the January $100 call, and you might buy the January $100 put. Okay, so we got the same strike, call and put, same expiration date. And let's just say that it's a net debit of 10 bucks. All right, that's just the net cost for these two options. So if you do that, this becomes our risk graph, the typical V-shaped graph. The maximum loss down here is the net debit, which is 10. We got positive deltas out here to the right, negative deltas to the left, but we also have a fairly wide range here of a maximum loss. That's the downside to the straddle. So what is a straddle-straddle swap? Well, a straddle-straddle swap, you are going to buy a long-dated straddle. Of course, that's relative, just something that's got a longer expiration date. And you will sell a shorter dated straddle against it. That's why it's called a straddle-straddle swap. You're just kind of taking the long and the short, playing them off of each other. So for instance, maybe you buy the March $100 straddle for a $10 debit, but then you sell the January 100 straddle for a $6 credit. So it would just be a net debit of 4 between those two. So here's what they look like individually. There's the long straddle in green, and there's the short in red. Now, the first thing that should come to mind is that you're long at 100 and short at 100. You're, in a sense, almost canceling them out, except that they have different expiration dates. So really, the only thing that we're altering here is the time to expiration. That's what's being played against each other here, and so that should be a little bit of a clue that it should be behaving like a calendar spread. Now, there's a number of ways that we could show this. Let me show you a nice little technique. One is to put things in terms of columns and then look at them as rows. So for instance, take a look at this left column, buying the March 100 call, buying the March 100 put. So that first column is our long March 100 straddle. Look at the second column. You're going to sell the January 100 call and sell the Jan 100 put. That's the short January right there. So we can see that these two columns are just the straddle-straddle swap. But now let's look at it horizontally. Right, these 4 options right here in green and red don't change. It's exactly the same strategy. We're just looking at it from a different angle. So take a look at this. If you buy the March 100 and sell the Jan 100, that is a long $100 call calendar spread. Look at the second row. Buying the March 100 put, selling the January 100 put, that is a long 100 put calendar spread. And so there's your answer. It's just 2 calendar spreads. So this is important because a lot of times traders say, how do you find edges? We get that question a lot in Q&A. Well, sometimes these edges show up as calendar spreads, and sometimes they show up as straddles. And yet you're really looking at the same thing. And this is why it's important to be able to break strategies down into these component parts. Let me show you another little technique. We can look at different expirations like this. Here is our long March 100 call. There's our long March 100 put. Here's the short Jan 100 call and the short January 100 put. Now think about this. If we take a synthetic long position against a short, it's just canceling. We've really done nothing. So take a look at this. I'm going to put a synthetic short up here. That's a short call and a long put. And the reason I'm doing that is to cancel out these puts. I'm just trying to convert all of the puts into calls. I can match that with a synthetic long down here. That's a long call and a short put. And look what happens. Again, the reason I chose that is to cancel out these puts. So these puts go out, these puts go out, and look what you're left with. 2 and 2. There's your 2 calendar spreads. Okay, so there's a number of different ways that you can dissect these positions to get better insights into what these strategies are and what might be an appropriate strategy for you. So there's our risk graph. It's just 2 calendar spreads. Once you understand that, what if we do a strangle-strangle swap? What's that? Well, we could buy the March 90-105 strangle, and we could sell a narrower strangle inside of it. Maybe sell the Jan 95-100 strangle. What is that going to do? Do the same technique, and you'll find that you have 2 diagonal spreads. It's actually called a double diagonal. So many of you have heard of that, but you might not have thought about doing it as 2 strangles. Sometimes it can be a whole lot easier to see them as 2 strangles, and also when you're looking for opportunities. So there's the double diagonal. There's the 2 bends that we get from the 2 different strikes of our near-term expiration. Just a double diagonal. But again, you can see it as 2 different strangles. So again, the main reason I just wanted to show this to you is a little technique that many of you can work with and practice with as a way to have a better understanding for strategies. Don't try to memorize them. Understand how to break them down. So as I always say, that's the whole key. And one of the big things that we try to show here on Trading Tune-Up. It's about making sure you understand, not memorize. So for anyone who'd like to learn more, there's a free 30-minute one-on-one assessment with one of our professional coaches. You can give that number a call at 888-809-8058. Love to have they'll book a session with you, any topic that you'd like to talk about. And then also, special deal coming up tomorrow, top 10 trading pitfalls and how to avoid them. You're going to get to meet some of these coaches. I'm going to be on there as well. We're going to have a little trading forum, little round table, talking about some of the big pitfalls and why traders end up making mistakes. So it's going to be really good. We're going to talk about that 4 p.m. Eastern tomorrow. You do need to register. So please go to marketrebellion.com. You'll see a banner at the top of the webpage, and you can register. And if you happen to miss it, you will get a follow-up email with the recording. So we hope to see you then. So I hope that helps. We'll look for you tomorrow, and then we'll look for you on Thursday and Friday for more Trading Tune-Up. Thanks so much.